The US bond market just crashed. A record number of investors are trying to sell their US bonds, which has driven treasury yields to their highest level in decades. And why is this so dangerous? Because in the last few months, the biggest AI companies like Google, like Meta, like Amazon ran out of money. So they are having to borrow it. And all the money they borrow is dependent on US Treasury rates. As Treasury rates get higher, these companies have to pay higher interest, meaning they can't make as much profit, meaning their share prices fall, the stock market falls, and the entire economy collapses with it. And if that sounds complicated, it's not. I'm going to explain it. If you own any US bonds or have any money in the stock market or are affected by the imminent collapse of the US economy, you're gonna want to hear this. Before we understand why the US bond market is currently crashing at levels we haven't seen since 2007, we should recap what the US bond market is. The US bond market is just a fancy name for the government buying loans. The US is basically an irresponsible teenager who spends more money than they take in. So the government asks its citizens or foreign investors for loans so they can spend more money. But a rational actor would think, why would I loan the US government money? I would rather donate to a literal serial killer. And the US government knows that. So in order to get people to loan them money, they offer interest. Where if you loan them money, when they pay you back, they'll give you a little something extra. So if 30-year treasury yields are at 5%, that means if you loan the government money, you'll get your money back at 30 years, plus a 5% interest rate every year. And when a lot of people want to buy US bonds, then bonds become a seller's market. The government no longer has to incentivize people to loan to them, so they can lower interest rates. But if no one wants to buy US bonds, at least until they release the Epstein files, then yield rates rise, because the government's like, oh god, I have to convince people somehow to loan me money, so I'll just pay them more money. And here's why this matters. Despite everything, US bonds are still an extremely safe investment. If you buy a 30-year bond, you're all but guaranteed to get your money back 30 years later with interest. And this means every other industry that's based on loans, like the auto industry, student loans, and the housing market, have to charge a higher interest rate on their money than the US Treasury. Why? Because all of those industries are riskier investments than the US government. Why would a bank give a homeowner a 30-year loan at the same interest rate as the US Treasury when there's a much higher rate the homeowner will default than the US government? To make up for the extra risk in loaning money to an individual person as opposed to the US government, banks charge higher interest. And so when US interest rates go up, every other industry's interest rates will also go up in proportion. So it becomes more expensive to buy a home, more expensive to get a car, more expensive to go to college. And then when everything becomes more expensive, people obviously spend less, and the entire economy slows down. In small doses, high interest rates curb inflation. But any more than that, and they'll cause a recession. Which brings us to the big news today. Interest rates have reached their highest level on record since 2007. And we all know what followed in 2008. So what's going on that's jacked interest rates so high right now, bringing us to the brink of recession? Well, I hope you're sitting down, because the two reasons are absolutely infuriating and somehow worse than the other. The first reason is that literally today, the US debt hit $40 trillion.
The U.S. national debt hit $40 trillion. And you can actually see this is a live clock on the screen of the national debt. It is ticking up dollar by dollar as I speak. And you hear $40 trillion, you think, okay, that's big, but
yes.
how big?
Yes.
It is bigger than the largest economy in the world, which is the U.S. economy. Mm-hmm. We're roughly $33 trillion when it comes to GDP. But the thing is that the national debt has doubled since 2017.
Someone said, and the United States wants to give me a credit score, LMAO. To give you context about how big that number is, think of $1 billion and then add 40 trillion to it. The US government now has to spend $1 trillion a year just on minimum interest payments on the debt. We're not talking about paying down the debt. We have to pay $1 trillion to make our debt grow slightly less fast. And we don't even have enough money for that. We are literally going over budget, paying the minimum amounts on our debt. So we are now taking out loans to pay back the interest rates on our other loans. Do you get how insane this is? And this drives up interest rates for two reasons. The first is that investors see the US government is $40 trillion in debt with no intention of paying it off, and for the first time in basically American history, investors are wondering if loaning money to the US government is that safe of a bet. Will the government actually be able to pay them back? I mean, that's why the US credit rating was actually downgraded for the first time in history. So the US government has to compensate borrowers with the additional risk of them going bankrupt by paying them higher interest rates, which makes it even more likely they'll go bankrupt. But the second reason this makes interest rates go up is when the US government needs to spend more money, they need more borrowers to give them money. So they have to incentivize people even more, and they do that by raising interest rates. But if you thought that was bad, wait till I tell you the second reason we're literally going into a recession. The second reason the bond market is crashing, potentially taking the whole US economy with it, is because the government is going broke spending money on, wait for it, AI data centers! Each level of US government is spending billions of dollars to subsidize data centers, making our deficits worse, with 38 states explicitly offering to compensate data centers directly. But if that's not bad enough, AI companies, as of a few months ago, have run out of money. So just like the US government and an irresponsible teenager, they're trying to get loans to build even more data centers they can't afford. And remember how earlier we talked about every company that's not the US government has to offer higher interest rates than the US government? Well, that's exactly what these tech companies are starting to do. They're offering higher yields than the US government, sometimes significantly so, which forces the US government to raise rates in competition because all the money is going to the AI companies instead of the government. Which brings us to the current sell-off. And guess what? It just gets worse. Now that people are selling off their bonds, the US government has to raise rates even more to incentivize new people to borrow from them, which makes everything get more expensive, which means people stop making purchases, companies can't make revenue, stock prices fall, and the entire economy goes into recession. This is a really big deal. I'm really into presidents, so I've watched every presidential debate, and there's really only been one moment that's always confused me. In 1992, an audience member asked President Bush how the US deficit has personally affected him.
How has the national debt personally affected each of your lives?
And Bush was confused, just like I was.
I think the national debt affects everybody. Obviously, it has a lot to do with interest rates. It has.
She's saying you personally.
On a personal basis, how has it affected you?
I'm not sure I get it. Help me with the question and I'll try to answer it.
But then Bill Clinton, old Slick Willie, responded to that woman very personally.
In my state, when people lose their jobs, there's a good chance I'll know them by their names. When a factory closes, I know the people who ran it. When the businesses go bankrupt, I know them.
And what Clinton was referring to is that when the deficit goes up, interest rates go up, the economy slows down, and people lose their jobs. That's how the deficit affects you personally. And I didn't understand that until now. And I don't think George H.W. Bush ever understood it. That's why he lost the election. So I hope you feel better now that you're more educated than a president. Well, you're probably more educated than a couple presidents. The Trump administration knows the bond market is crashing. So today, Treasury Secretary Scott Bessent is trying to stop the bleeding. He announced the government is going to do huge Treasury buybacks, which is literally when the US government buys their own debt. But the catch is they can't even afford to buy their own debt, so they're going into debt to buy back their own debt to prop up the price of their debt that they're paying themselves. It's a total scam, but this worked in curbing interest rates for a day. Interest rates went slightly down yesterday, and they're back up today.
Today, the U.S. announced that we are buying back our own debt because nobody else wants it. I'm a monetary analyst. It's what I do for a living. I study the dollar. And a year ago, almost to the day, I predicted that yield curve control was coming, which is essentially when the U.S. Ponzi scheme really kicks into high gear and is exactly what we're seeing today. Instead of the Fed issuing new currency to buy the debt, the U.S. Treasury is issuing more debt to buy our existing debt so we can keep issuing more debt. And if that sounds confusing, it's because it is. You don't need to know all the technical details. All you have to know is that the media is going to tell you that this is not technically quantitative easing, that inflation will not rise because of this, but do not be fooled. What they're counting on people not realizing is that yield curve control was used here in the US during World War II, when spending exploded and there were no buyers of debt. So what did they do? They said, we'll just buy our own debt. This will guarantee the interest rates won't rise that much because the second they do, we'll just keep buying all the debt. Which sounds great in theory. They saved the system, but guess who paid? Everyday Americans. In just a few years, inflation jumped up to 18%. Can you afford if every single bill in your life jumps up another 18%? But not only that, the debt today is 10 times what it was during World War II in real terms. That means inflation adjusted, meaning that today's fallout would be far worse. We could be looking at not only double-digit inflation, but far greater than 18%. What this is really telling us is that the U.S. is growing more and more desperate, and that they're having to step in at a much more frequent rate. And every time throughout history that a country has had to do that, it always results in higher inflation for the citizens.
The stock market just had its worst day since July 29th, which was literally its worst day of the year. Tech stocks are tumbling. Health and finance stocks are falling. And now that the US debt has hit $40 trillion, Japan, China, Taiwan, Saudi Arabia, India, the UAE, Norway, and Singapore are all selling huge portions of their US bonds because they're not certain the US will ever be able to pay them back, which of course will make interest rates rise even more, and the war in Iran has made oil more expensive, which contributes to massive inflation, 3.8%, which is 90% higher than what it's supposed to be. And when you measure inflation in wholesale prices, inflation is actually at 6%, which is why the stock market currently expects with 75% certainty that the government is going to raise interest rates again. I feel like every single thing I've said in this video is just this is why the government's raising and raising interest rates, which will just make everything more expensive. And if you don't believe me, the New York Times just published a piece yesterday saying everything is about to get a lot more expensive.
Chris Waller, who was one of the first people to vote for rate cuts, he's now saying he's prepared to vote for rate increases if the war goes on and inflation does not come down. Here's a line from his speech. I can no longer rule out rate hikes further down the road if inflation does not abate soon, and that is especially true if measures of inflation expectations, some of which have risen lately, show signs of becoming unanchored.
Right now, the market is predicting a rate increase by January 2027. In fact, we are over 70% odds that interest rates will go up, which is the opposite of what everyone thought would happen. Because a year ago, everyone on Wall Street was betting that the Federal Reserve would lower rates 3, 4, maybe 5 times by now. Goldman Sachs was saying this. The bond market is predicting it. That was allegedly the reason why Trump wanted Kevin Warsh as the new Fed chair, so that he could lower interest rates. But that's not what happened. Here's what happened instead. 2 of America's biggest foreign buyers of debt are now selling U.S. government debt. The trap is that the Federal Reserve cannot lower interest rates because if they do, it would break the bond market. And a broken bond market would affect everyone. It is our mortgage rate, it's our credit card interest rate, it's the cost of every loan, every student loan, every business loan in America. And it is also the U.S. government's ability to pay things like Social Security, Medicare, and the military.
And the same trends are happening in every country because people do what the U.S. does. So once this dam breaks, it's taking down the entire global economy. Take a look at how sharply Japanese bond yields has risen. And this is dangerous because when Japan can't pay back their bonds, they sell their U.S. bonds, which, you guessed it, drives interest rates even higher. Which is also why, if you didn't hear, the US just spent billions of dollars of your money to bail out Japan. Because if we didn't intervene, they likely would have been headed for a recession, if not a depression. But we can bail out Japan. There's no country big enough to bail out the United States. And the real reason we bailed out Japan, even though we said it was a sign of deep friendship, was because we didn't want them to sell all their US bonds, which would make, say it with me, our interest rates go up. So, are you following along? Basically, we are paying a country to continue borrowing money from us so we can keep lending money at lower rates that we lend to ourselves. Also, we can make minimum interest payments on our $40 trillion debt so we can buy more AI data centers. That's the state of the economy in a sentence. Stick a fork in us and call us cooked. We're not even cooked anymore. God, we're deep fried. Economic historians say the debt to GDP ratio that makes a country completely unsustainable and headed for complete fiscal collapse is 100%. Well, a $40 trillion debt just brought our debt to GDP ratio to 122%. And The final can of gasoline poured on this dumpster fire, oh god, there's another one, is as inflation rises, thanks to the war and everything else I've mentioned so far, interest rates will have to rise even faster. Why? Because if US bonds hit an all-time high of like 5.5% and inflation is 3.8%, well, people are only getting like a 1.8% return on their money. And that's a terrible ROI. So the government has to, say it with me, everybody, raise interest rates. So all these factors are coming together to keep inflation high and interest rates higher and the probability of recession highest of all. But I'm gonna tell you guys something. I lied. There's actually something that makes everything even worse! God, it's really crazy. A ton of the funding for AI companies comes from private equity policies tied up in life insurance. Life insurance companies that have a guarantee no other company has. That if these companies fail, the US government will bail them out. Meaning, when AI companies crash, the US government has legally declared that they will use your tax dollars to pay all their bills and bring them back. Which of course will exacerbate the deficit, skyrocket inflation, and everybody's favorite, raise interest rates! So all the AI companies get unlimited money from us. They'll just continue to privatize profits and socialize their loss. Usually in a moment like this I'd say that rhymed, what a banger. But this is too serious for rhymes.
$1 million 1993 today is now $2,070,000. Inflation in 5 years will probably devalue half of everyone's money listening to this in their 401ks, IRAs, and their soft saving accounts. Like right now, the world is a wreck, and their only solution to the devaluation is they're gonna have to work harder. Over the last 20 years, 2002 to 2022, salaries have increased 27%, but the cost of a home has gone up 148%. In other words, like our cost of living and lifestyles is not keeping up. Average person drives a $60,000 a year car that has a $50,000 a year salary with over $100,000 of student debt, 60% of America living check to check. We have a problem. And being busy is not the solution, and getting another job is not the solution. You have to graduate and develop more of the Gen Z millennial mind that says there's got to be a smarter way. It can't be the immigrant way of just work harder, because there is something to say for hard work. But if it's not smart enough hard work, then it's stupid work. It's dumb work. And there's a lot of financial idiots out there that have just not gotten themselves educated.
Yeah, and so even though our government is messing everything up, don't let that be you.
Things my parents taught me about money that schools didn't. Schools teach you how to earn money, but very few people teach you how to multiply it, and that difference is everything. First is that you don't build real money on salary alone. If your only income is tied to your time, then your growth is capped at 24 hours a day. I try to keep 5 income streams at all times, whether that be exposure to broad market ETFs, equity, real estate. Some people have a side business. Next, the younger you are, the more risk you can take. In your 20s and 30s, that means heavily allocating your money into equities rather than overloading on bonds. With decades ahead of you, volatility is uncomfortable but not catastrophic. Lastly, any cash sitting in your bank is losing value. Inflation averages about 3% long term, so that means your money halves in value every 20 years if it just sits there.
She has a lot of good information in there, but I also want to warn you about seeing posts like this.
Sell everything. Stocks, shares, bonds, commodities, property, crypto. I don't care what it is. Get out of all markets now. Exit. Exit all markets. Do you understand? I'm one of the owners of the largest hedge fund in the UK. And we went off risk 2 days ago because we know what's about to happen. The reason why gold is spiking through the roof like it's World War III is because the everything bubble is about to collapse. This means that everything will essentially go to zero. Everything that has value will go down by at least 98%. That includes the money in your bank account.
Even though all financial foundations of the US economy are coming apart at the seams right now, recessions are like the second coming of Jesus. No one but God in heaven knows the exact date and time. So please do not try and time the exact moment the stock market crashes. Buying and holding for the long term has always yielded the highest financial returns.
The stock market during COVID? 6 months later. The stock market at the start of the war in Ukraine? 2 years later. The stock market during the Trump tariffs? 5 months later. The stock market at the start of the war in Iran? 1 month later, the stock market will fall sometimes, but it will always recover.
Yeah, it's recovered in the long run so far. We've never had an economy that's had all the variables working against it like this, that could actually completely destroy the foundations of the US economy. And even if it eventually bounces back, that doesn't change that it's totally gonna wipe out the AI companies, wipe out savings accounts, make people declare bankruptcy, get people laid off, companies shut down, and have the US lose its status as the global reserve currency, as the economic hegemon of the world. Like, it's hard to overstate how wildly transformative a recession or a depression can be. There's a reason that communism and fascism both started in crises, the World Wars and the Great Depression. This next recession is going to bring out some of the craziest things we've ever seen in economics and in politics. Someone rightly pointed out this is why gold has been surging lately, because people know the US government is headed for bankruptcy and the economy is headed for collapse.
There are some economists who suggest that because Mr. Trump ties his success to the success of the market, that he's not going to let anything like what happened in 1929 happen, and that we should feel secure because of that.
I think it's hard to know how things get out of control. When confidence disappears, it happens like this.
Do you think that we will have a crash or not?
I can assure you, unfortunately, I wish I wasn't saying this, we will have a crash.
But there's a lot of people who don't want you to hear this.
Something strange just happened. They just shut down the CERN Collider, which has been operating since September 2008. Do you know what else happened in September 2008? The biggest financial meltdown of the 21st century. The last time they shut down the Collider was 2018, just weeks before the entire world went into lockdown. Right now, we are sitting at almost identical market levels that we were in September 2008. The man from The Big Short that predicted the 2008 financial crash just posted today, "The end is near for the stock market." The Collider is shut down for the next 4 years for a major upgrade opening in 2030. How convenient. Agenda 2030, digital IDs, digital currencies, global surveillance states, 15-minute cities, you'll own nothing and you'll be happy. Coincidence? I don't think so.
Someone said, just buy the dip. My brother's last words before he fell into generational debt. Cooked. And as interest rates go up, people are trying to figure out how to pay off their mortgages even faster. And this dad thinks he cracked the code.
Hey Dad, Austin and I are about to buy a house and you guys paid off your mortgage faster. How did you do it?
Well, it's not as difficult as it sounds. What we did is we took the 30-year mortgage. Now, the reason we did that is because then your monthly payment is so much less. During the year, if you make one additional monthly payment somewhere along the line, it can be one big payment or 12 small payments. But if you make an extra payment every year, that comes straight off the principal, not the interest, and it will cut your loan down from 30 years to 17.
That's smart.
Excuse me, miss? What kind of summer are we having?
Bond girl summer.
What does that mean?
So we're like buying government debt.
Well, Taiwan, the UAE, Norway, and Saudi Arabia aren't buying US bonds, but I'm glad this one random girl in Cincinnati is. That makes me feel better. Because every time the stock market crashes 700 points like it did today, you basically have a bloodbath on Wall Street. It becomes a frenzy.
If money is evil, then that building is hell. This is the most obnoxious group of money-hungry, low IQ, high energy, jackrabbit, fucking wannabe, big time, small time, shit talking, bothersome, irritating bunch of motherfuckers I have ever had to endure for more than 5 minutes.
In ancient Greece, there was a king named Dionysus who killed and oppressed his people. Because he was so hated, he constantly lived in fear that someone would assassinate him. One day, his courtier exclaims, "Dionysus, you must be so happy. You are the king with every luxury in Greece. If I lived like you just for one day, I could not know any greater contentment." "Very well," Dionysus said, and the two switched places. Dionysus brought his courtier Damocles into his grand palace as servants rolled out a purple carpet before him. Damocles sat down on the king's throne before the most sumptuous feast in all of Greece. But a little nervous, Damocles sensed something above his head. Well, he looked up and he saw a razor-sharp sword dangling above him by a single horse's hair. Damocles' smile vanished. He started to shake. He was no longer hungry. He could no longer enjoy his 25 servants. "What's the matter?" Dionysus asked. The sword! The sword! Damocles cried. Dionysus said, yes, now you know what it's like to be the king, like me. But Dionysus might as well have said, now you know what it's like to be invested in the US stock market. If one thing goes wrong with these AI companies, or if the bond markets crash, or if interest rates just get a little too high, which literally everything is conspiring to make happen, we're just one horse's hair away from the sword falling on us, like Damocles. So is today's 700-point crash the first of many days? Some people are already feeling it. But a few people are happy.
This is a great time to be someone who spent all of their money on special treats instead of putting that into a stock portfolio or an IRA or a 401k or a high yield savings account, because the stock market is down, but the special treats market, booming.
Honestly, I don't know what boomers will do when their house prices start to fall and continue falling and keep falling. Basically, everything depends on whether the chair of the Federal Reserve, Jerome Powell, lowers or raises interest rates.
Good afternoon.
That's true, but I'm just worried this is going to make our economic problems so much worse and take us even further away from the idyllic world of the boomers, where you could buy a house for like 3 nachos and a piece of toast.
Somebody bet on the bay. The Camptown ladies sing this song, doo-da, doo-da. The Camptown racetrack 5 mile long, oh, doo-da day. I come down there with my hat caved in, doo-da, doo-da. I go back home with a pocket full of tin, oh, doo-da day. Riding around all night, riding around all day. I'll bet my money on a bobtail nag, somebody bet on the bay.
Yeah.
Update on the Federal Reserve. They are going to print money. Hear me. They are going to print money. What does this mean? It means the dollar is going to be weaker. I need you to hear this because you're going to get blindsided by it and you're not going to know what happened. They're going to do what's called expanding their balance sheet, which is code word for quantitative easing, which is code word for money printing, which is code word for the dollar is going to inflate and get weaker. So if it's sitting in a bank account just idling, it is going to become weaker. I need you to hold assets. I need you to hold assets. If you don't own a home, if you don't own gold, if you don't have crypto, if you don't have some form of stock investment, you need to. You need to, because here's one thing that's going to happen. One of two things, and both roads lead to Rome. One, we print money. We quantitative ease, we expand our balance sheet to add more money into the economy, which simultaneously weakens the dollar while adding more credit and create more debt so that our debt-based economy can keep operating. All right, that's number one. But number two is we see a system snap. Stock market, AI bubbles looking crazy. Job market looks terrible. We could see a system snap. Something where the bond market goes kablooey. Something that creates a 2008-like effect on the stock market and other markets. What that means is they're just simply going to print money right after that. So here's what I would tell you to do right now. I would have your money and all assets that aren't exactly connected to the stock market. I would have a very little allocation in the stock market right now. I do not believe in it long term. But if you're planning on holding it for 10 years, go crazy. Here's the point. When we print money, assets go up. And the moment you hear the word quantitative easing, I need you to be ready for the quantitative easing rise. We saw it from 2020 up through 2023 in the stock market. We saw it from 2008 onward through 2018. The stock market, the housing market, every asset you can own from a watch to a car to a business went up in value. If we print money, assets will melt up. If we don't see money print, but we see system snap first, that means melt down followed by melt up. This all may sound a little bit confusing, and it also may sound a little doomsdayish, but the thing about it is we have to print money. We're going through a liquidity crisis. Look at the repo market, look at what different banks, look at what Jamie Dimon is saying about cockroaches in the kitchen. We are walking into it as we speak, and I want you to be prepared for it and not reacting to it, or not being like, why is this happening? This is what is going to happen. We are going to quantitative ease. We are going to expand our balance sheet. And this means you need to be diversified in your assets. And if you don't own any assets, try to get an asset. And if you don't make enough money to even get close to owning an asset, you should make sure you're in a job that in a recessionary period, you're not going to lose. You know, we've been seeing layoffs. We've been seeing people getting let go from their job. Like, you need to make sure you have security in your position, your career.
Right. One way inflation doesn't destroy you is if you have your money tied up in assets that also rise with inflation. And the inflation will start in the bond market.
Watch the bond market. The bond market is the basis. It's the backbone of all markets.
The bond market is the canary in the coal mine.
What do you think about the stock market, Mother?
It's plummeting.
Why?
Because of Joe Biden and Kamala Harris.
How?
Because they've got our country in shit shape. And now Donald Pump.
Someone said, did she say Donald Pump? I think she did.
Donald Pump.
Who's calling that? Who's calling that shit? Who's calling that shit? Who's calling that shit?
Very true. How dare we not invest when we were 2 years old?
How dare we?
This crash is finally Gen Z's chance.
The economy's so fucking bad, it'll have you thinking you bad with money, and all you did is buy groceries.
Bro, that is so true. Like, this inflation is not in our heads. And anytime a boomer tries to tell you, just work harder, show them this.
Derek, can you tell the class what you just told me?
How much would minimum wage need to be today to match the home buying power of boomers getting minimum wage in the 1970s?
My guess was $35. Okay, what's the answer?
$66.
That is diabolical.
Someone commented, I paid for college with my summer job. Yeah, I bet you did, Roberta. My summer job pays $9 an hour. Minimum wage converted to an annual salary is $137,000, by the way. Boomers had it so easy.
Big Pluto, bitch, like what the fuck? Sign down, Abby with the brew, you know we did before. He won't, he bet her here, duck can't get.
Someone said our country basically has 30 minutes left. Yeah.
They're doing the best to hide that we're in a recession because they want you out there freely spending your money up until you can't. That's why they're trying to convince you that looking at the stock markets is how you figure out what the economy is doing, but realistically, it's the consumer. Like, time and time again, I see people saying, like, oh, if it gets too costly, what we're gonna do? People have already started doing. They've already stopped paying. They're trying to convince you so much that there's so many gains to make in the market right now, but realistically, it's very erratic in there. People are having big gains, but they're also having big losses. If people are spending less and less and saving more, well, good luck, Charlie.
Someone said we've technically been in a recession since COVID. We're past a recession now. The numbers don't quite put us in recession territory yet, but we're heading in that direction. People can't even afford basic things.
That's my house, that's my car, that's my dog in my backyard.
Someone said, honestly, I'd rather live in a trailer than have $1,200 rent for an apartment. Yeah, fair enough.
There is absolutely no way y'all are surviving this economy without financial fraud. I know all of y'all are doing financial fraud. There's no way you taking your second trip to Europe this year in this economy.
Someone said, I donated my eggs and I got $50,000. The creator responded, cries and polycystic ovary syndrome. A bottle of ketchup is $10. I gotta work an hour for some fucking ketchup? Yeah, that's absolutely ridiculous. I'm just imagining, like, every time you squirt ketchup, you're like, that's 5 minutes of labor. That's another 5 minutes of labor. The economy is also slowing down at a record rate because immigration and birth rates are cratering, meaning there's fewer workers to even, do the work of the economy. It can't all just be like tech CEOs. We know that, right? And Japan has even lower immigration and birth rates than we do, which is why their stock market is already crashing.
In 2024, Japan's population fell to 123 million. That's down from 128 million in 2010. And by 2070, the government expects it to plunge below 87 million. That's a decline of 32% in just one lifetime. But the real crisis?
It's not how many people Japan has, it's how many people are left.
Japan is is now the oldest country in the world, with 30% of its population over the age of 65, and nearly 1 in 10 is over the age of 80. There are now more adult diapers sold in Japan than baby diapers. In some towns, schools are shutting down, replaced by elderly care centers. Rural villages have turned into ghost towns, with forests swallowing abandoned homes. And here's the thing, while much of the developed world faces aging populations, most countries have one major advantage that Japan refuses to embrace: immigration.
Japan has our economics and demographics. They're just ahead of us. So it's no surprise that our job market is starting to look as bleak as theirs.
Oh, you're not trying hard enough? Yeah, I applied for 1,084,209 jobs. You have the audacity to tell me that I didn't try in 2025? Of that number, we only got a whopping 2,222 who actually gave me a shot. That means over 100,000 companies literally said, go screw yourself. Oh no, it gets worse. Second round interviews dropped all the way to 467. Then we go to the third round interview and we only got 6 final interviews.
And we're all struggling with our own debt, yet we're paying $1 trillion of the governments every year?
Let me tell you guys how I'm about 16K in debt, bro.
Pull up at a fucking Kia dealership.
I have a 28.9
APR rate at $570 a month.
And there's no avoiding this now.
I have a plan. If I got me a wealthy man.
We can't even afford to make reckless financial choices because we have no money to be reckless with.
What is this car?
It's a 2017 Ford Mustang. It was a $25,000 car.
What's the minimum monthly payment, my dude?
$556.
What's the interest rate on this?
24.1%.
No.
Yes.
Dude, the interest rate is higher than your literal age. What's your insurance?
Car insurance payment is $770 a month.
Who sold this to you? I need to go beat the shit out of this person.
It was CarMax. I thought I could trust them.
Oh, yeah, it was. Do you know how absolutely life-ruining that is to your finances?
I would be willing to sell my car for a more expensive, newer car.
What are you talking about?
So, other people that have had the same income and position at my age, they've been approved for $50,000, $60,000 cars. I like luxury, that a Lexus RCF. It's like a Japanese Mustang, is what they call it.
Someone said the dealership after he left with 24% interest. So the only people celebrating that interest rates are at historic highs right now is anyone who bought a house when interest rates were so much lower in 2021.
I don't give a fuck. I'm still in the motherfucking house. I'm still in the motherfucking house. I don't give a fuck. Do I look like I give a fuck? Because I don't.
And if any of Gen Z ever does get a mortgage, you should never pay more interest than you need to.
Congratulations on closing on your first home. Your loan is for $300,000 at 3.5 interest, and your monthly mortgage payments is $1,347. Sounds good, but I'm actually going to be paying you $1,500 per month. Why would you do that? Well, I know that if I just made the regular monthly mortgage payments, then I'll be paying about $185,000 in interest over the lifetime of the loan. Yes, that's correct. But if I pay an additional $153 per month, my total interest reduces to $151,000, saving me $34,000 over the lifetime of the loan.
Caleb Hammer has gone viral for this piece of advice, but I'm not sure it fully applies today.
So would you say not get a house today because of interest rates? It's S&P 500. It just beats real estate. Getting a house requires a massive amount of money for a down payment. And in renting, you don't have to do maintenance. You don't have to get a new roof. You don't have to deal with the AC going out. They'll have someone on standby that'll fix your overnight. With the incredible stock market that we've had over the past 50 years or so, it beats it every time. If you rent and just put your money into the stock market instead of that down payment on a house with a little extra for a mortgage, you'll win every time. That being said, Americans suck at investing, so if the only way for you to invest is put your money in a house that you literally cannot touch, maybe it makes sense, because you need that forced investing. Yeah.
While it's true that you want to be invested in the stock market broadly, but the S&P 500 is more overvalued than the Dow Jones. So it can be good to invest in the S&P 500, but be careful and maybe consider diversifying further. The S&P, after all, has had a lot of close calls in the last few months. Bottom line, don't be like these people.
She took out a $500, 900% interest payday loan. You borrow $1,000 for this one, you pay back a total of $4,413. Why did you take this out? Be real.
I bought a PlayStation 5. Really wanted one. So
nothing like collections for PS5s. This is at a 792% interest rate. You borrowed $500.
Yes, yeah.
What's your total you're paying back by the end?
$2,000.
$4,000 for $500. They started garnishing your wages from this loan?
Yes.
You gave them access to your account?
Yeah.
This isn't a government. They can't just garnish unless you give access. This is a payday loan. This is at a 573% interest rate.
We did need that advance. We were going on a trip to Galveston.
To Galveston? It was to Galveston. To Galveston? It wasn't even to like Cabo or something. I make good money doing this, don't get me wrong. But look how much more money can be made out there if you just have no morals. They gave you $500 and they make $3,500 of profit? Oh my goodness. How much debt do you have?
I think around 40,000.
Okay, it's about 50. And you consolidated under a 35% interest rate.
I didn't understand. I thought it'd be better just under one payment than multiple.
Consolidating to a 35% interest rate? They're making so much money off of you. Why didn't I just start a company like that instead?
And please, don't be like this woman. Oh boy, I bet she would join the Chum Bucket Bank, run by Plankton himself, if they had like Krabby Patties on their credit cards. And now, the Congressional Budget Office just released a prediction that our minimum debt payments are going to surge another $100 billion a year by 2028. So this is only gonna get worse. If you have any money, hold on to it now, because you won't have it long. Inflation's coming, interest rates are gonna rise, so if you can, put your money into assets. What's your financial plan? I'll respond to as many comments as I can, so let me know. And thank you to our amazing patrons who make this possible. Bob Rick, I'm Magnus, Magnus, Jae Minton, Aaliyah, Sami Mohammad, Avery, Gerard, Beth, Pillow, Wendy, Pineatoo, Eli, Sylvie, Caroline, Alex, Planet, Zak, Oz, Neptune, Coco, Drake, C, Jenny, Bess, Michael, Jase, Sal, Sonder, Kelly, Dylan, Brett, Ari, V, Guy, Bond, Doge, Land, Edang, Job, Angel, Rachel, Ariel, Viper, Ava, Alex, Comfort, Puffy, Marshall, Christina, Brandy, Odell, Jackson, Ellen, Caroline, Woody, Kelp, Deanna, Ree, Aaron, Addie, Soka, Knight, Sears, Alan, Random, Lemon, Becca, Slim, Aaron, Connor, Chasm, and welcome to our newest patrons, Matthew Knob, Alan the Cat 7, Graziella, Tamsin Belcher, and Dark Odin. Spooky! I'm so excited to meet all four of you. Thanks for watching.